Hey everyone, SoFi stock is down 64% off its highs that it reached in 2021. But is SoFi stock a buy in 2024 or before 2024? That's the question I'm going to answer in this video. Now, to answer that question, I'm going to take an overview of SoFi's business. It's an online bank slash financial services company. And I'm going to look at the structure, the risks. I'm going to look at its revenue, its valuation, the growth in assets and employee count, and all that, and put it together to come up with an answer of what I think of SoFi stock for 2024. So let's get right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So since becoming a bank, a big part of SoFi's business is collecting assets from depositors and making loans and earning a profit from that process, right? You get money from depositors and you make loans, and you need to earn a spread between those two. How much do you pay to get deposits and how much do you earn from making loans? Well, here's a breakdown of that from SoFi in its third quarter and going back a couple of years. But let's look at the most recent quarter where they had $22.8 billion in deposits, and they've been good at attracting deposits. That's one thing that they've had success with. They've been offering investors, or depositors I should say, a robust yield for their checking and savings accounts to bring their money to SoFi, and that's bringing in customers. That's been working. So they've got 22.8 billion in assets in deposits, right? So the problem is now that they're paying for this. They're paying for this, right? That's $22.8 billion of money that SoFi is paying interest on. On average, they're paying 4.12% interest. I'm drawing your attention down here to the bottom right hand side. Interest bearing deposits, the average rate, they're paying 4.12%. And you could see this has risen significantly over the last several quarters, right? As SoFi has tried to stay competitive with other places where people can earn money on their cash, right? Interest rates have increased substantially since the Federal Reserve started raising interest rates over the last couple of years. Now, in yesterday's meeting, the Federal Reserve suggested that in 2024, they could be cutting interest rates, but I think it's a little early to speculate on that. Still, SoFi is paying an average 4.12% on that $22.8 billion in deposit. So you can imagine how much cash is going out from SoFi to pay interest on these deposits. So they need to make loans. They need to make loans and charge a higher interest rate than what they're paying their depositors so that they can earn money, so that it can be profitable. And thankfully, they have been doing that. On this bottom line here, NIM stands for net interest margin. That's the difference between what SoFi earns from lending and what they pay for the cash. Now, they don't only get the cash in deposits, they also borrow some money. And you could see here for debt, they pay higher interest, 5.23% interest for debt compared to 4.12 for interest bearing deposits. So overall, 4.4% average rate. But what they've been earning is a 6% spread. The difference between that has been 6%. So that's a nice solid spread that SoFi has been earning between lending and depositing. And that's a good foundation for the business. If you're a bank offering these types of services, it's a good spread to earn. Now, the risk is, let me show you what the risks are for SoFi. So initially, SoFi started out as primarily a student loan lender, which is less risky than personal loans because student loans are not, you can't dispose of them during bankruptcy. And so consumers that are unable to pay, they can't wipe out their student loan the way they can with personal loans. And on a ladder where you're thinking about the riskiness, personal loans are the most risky type of loans you can make as a bank, right? Home loans being one of the safest car loans being the other one of the safest, because those loans are backed by collateral. If those customers don't repay, you can foreclose the home or repossess on the car, and so you don't lose all of the money that you lent out. Okay. SoFi, however, has been making primarily personal loans. You could see here 14.177 billion in personal loans, and on the balance sheet the fair value is 14.8 billion are personal loans of the 21 billion in total. So a significant percentage of their overall loans are personal loans. In fact, let me show you the precise percentage. I have calculated it for you here, and you could see over the years, in the third quarter of 2021, only 41% of SoFi's loans were personal loans. In the third quarter of 2022, that increased to 61% of SoFi's loans were personal loans. In the third quarter of 2023, the most recent period which we have an update, almost 71% of SoFi's loans were personal loans. So you could see the business getting riskier and riskier and riskier and riskier because a greater percentage of the loans are personal loans. However, for 2024, I suspect this to improve. Why am I saying that? Well, in October, the moratorium on student loan repayments ended. So now people have had to make their student loan payments. And so I suspect that's going to increase in activity for student loan refinance demand at SoFi. That's one thing. The next thing is SoFi acquired a home loan company, a mortgage company, and it's integrated that into the business, and it should be making more home loans in 2024. So the combination of those two factors, I expect, will increase or decrease the proportion of personal loans from overall loans. So that's one good thing. The other good thing is that I mentioned already, the central bank said that they are more likely to cut interest rates in 2024 than to raise interest rates. And given that the economy looks like it's going to avoid a recession, these personal loans may not turn to default as at a great percentage. These are more likely to default when people lose their jobs and income prospects are lower. But if the economy is doing well, then people typically repay their loans and repay their personal loans. So if the economy is going to perform well in 2024, that could mean good news for SoFi's loan portfolio and the performance of SoFi's loan portfolio. So now let's look at longer term. How has SoFi done? And I mentioned already it's done a good job growing revenue. 537 million in revenue in the most recent quarter. That was up from less than 150 million in July of 2022. That's a solid growth rate. And I mentioned already that's come at some risk, right? By paying depositors a higher interest rates than your competition, you've attracted deposits and you've been able to make loans from those deposits and generate revenue, but you've also increased the risks of the business. And SoFi has shown little progress towards profitability. Here I have the net income over the trailing 12 months, and you could see it's up and down. It was making good progress, then back down, negative 388 million. And I would say that the company seems to be more focused on growth than it is on profitability. The CEO is always talking about growth, growth, and more growth, and being everything to its customers. It wants to serve your every single financial need that you might have. Not just make you a student loan, but also make you a home loan, help you save for your students, for your kids' college fund, help you save for retirement, help you make investments, help you with this and that. They literally want to do everything that you could need in your financial life. And that is going to come at the expense of near-term profitability. While it might pay off in the long run, in the near term, it's going to be expensive and it's going to lead to difficulty with profitability. And we mentioned already that SoFi's assets have been growing, and you could see here from close to 6 billion up to 24.68 billion in total long-term assets. And all else being equal, you'd prefer a bank or any business to make more revenue and more profitability on a smaller base of assets. That indicates the company can grow with fewer expansionary spending, with fewer capital expense, with fewer needs for capital, right? With more needs for capital, that means growth is harder to come by. It needs to spend more and more to achieve a smaller and smaller growth rate, right? So this type of asset growth from less than 6 billion all the way up to 24 billion, and looking at the revenue growth about 3x or close to 4x, and then little progress on profitability here. I'm not seeing a positive trend here except for this brief moment and then back downward. Now, they have said they're going to make progress on profitability. They have said that they might get net income profitable in the fourth quarter, but we've yet to see this on a consistent basis. We want to see more consistency of that, especially considering you've attracted so much in assets. And similarly, they've hired a good deal of employees, going from 2,500 employees in January of 2022 up to 4,200 employees in the most recent update. That's a growth of 1,700 from a base of 2,500, so nearly doubling your employee base. That means a greater expense, greater salaries, and you've got to onboard people, you've got to integrate them into the business, which is not an easy thing to do, and it takes time. So I wanted to look at SoFi's total long-term debt there in the purple and average diluted shareholders outstanding in the orange. So total long-term debt with SoFi stands at 6.25 billion. All else considered, their total debt is not very high considering the scale of the business. So I wouldn't say that long-term debt is a risk factor here. And then shareholder dilution is growing, right? They had 400 million shares outstanding in 2021. That's increased to 951 million shares outstanding. And shareholder dilution makes it so that when the company does reach profitability, the earnings per share will be lower because there will be more shares to split those profits with. And finally, I wanted to look at the valuation, and SoFi is trading at a forward price to sales of 3.57. While it's down from the high of around 12, it's also up from where it started the year, closer to 2. And it seems like it's improved prospects because SoFi's prospects did improve as the year went on. The two factors I mentioned earlier being the primary reasons, right? The central bank looking to cut interest rates in 2024 is very good news for SoFi. And then the second thing is the restart of the student loan payment. That's good news for SoFi as well. So going into 2024, its prospects are better than they were going into 2023. But at the same time, the stock price is more expensive than it was going into 2023. Significantly more expensive on a forward price to sales ratio. And so for all those things, if I was to say if SoFi stock is a buy for 2024, I would say it's not. But I wouldn't be surprised if after the first quarter or 2 quarters, I was to change that recommendation and upgrade SoFi stock to a buy. If the first quarter results come out and I see significantly more demand for student loans and I see significantly more demand for home loans with SoFi's business, and at the same time all the other parts of the business continue the way they have been progressing, then I wouldn't be surprised if I upgrade that recommendation. So those are the main things that are holding me back, is that big percentage of the total loan portfolio being personal loans. And I want to see more progress on the other parts of the business in the loan portfolio before I can upgrade this stock to a buy. But it's very close. It's a hold, and I wouldn't be surprised if I upgrade to a buy at some point in 2024. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.